Hello, it's Kenny Burdine. I'm going to take a few minutes and walk through some of Kentucky's major livestock species, give you some perspective on 2020, and talk about what I think we're likely to see in 2021. I'm going to begin with equine markets, and I reached out to my friend and colleague, Dr. Jill Stowe, to get some of her thoughts on equine as well. It seemed like it took equine markets a while to recover from what we generally call the Great Recession, but they had built a lot of momentum over the last several years. And receipts had actually exceeded $1 billion in the state for both 2018 and 2019. And in my opinion, they were headed that way again in 2020 until COVID. But Kentucky's equine receipts come from two major sources, the first being stud fees, they tend to come early in the year, the second being sale values, that tend to be later in the year. The timing was such that I think the impact on stud fees in 2020 were fairly small, but we did see a decrease in the number of mares bred. What we definitely saw was a major impact on fall sales, both in September and November. One way to gauge this is look at Keeneland's annual sales. If you look at 2019 versus 2020, they were down roughly 30%. Now, in all fairness, they canceled an April sale. They still have a December virtual sale that will provide some receipts, but it's going to be down quite a bit. As we look at 2021, it's inevitable that we're going to see a decrease in stud fees, down about 15%, I think, compared to the current year. I think we'll also see a decrease in the number of mares that are going to be bred in 2021. So both of those are going to put us in the beginning of the year behind 2020 levels. I do think there's potential for some improvement in sale values come fall. And one reason why that I think that's the case is while we talk about gross numbers a lot, and rightfully so, if you look at the average and the median sale values, they weren't off near as much. In some cases, they were flat. Now, some of that was supply driven, no question, but I do think it gives some reason for optimism that we can see improvement from the COVID impact quicker than we saw improvement from the recession back several years ago. I do think, though, we see another probably double-digit decrease in equine receipts as we think about 2021 versus 2020. We came into 2020 again with fewer dairy cows in Kentucky. That's been the case year after year. Been a very volatile year. That's been the case for most all livestock species, but dairy probably more so than any. Put it in perspective, our U.S. all milk price for May was $13.60. That same U.S. all milk price by July was $20.50. So incredible volatility. To put that in perspective, I went back and I grabbed prices of U.S. all milk going back to 2014. And I grabbed 2014 on purpose because this was considered to be probably one of the best years we ever had in the dairy sector. I want you to note, though, that at the end of 2019 and summer of 2020, we saw the highest U.S. all milk prices we had seen since that 2014 time period. So that was significant, although certainly very volatile. Now, understand that in Kentucky, we did not get the full benefit of either one of those price peaks for two main reasons. The first goes back to the last farm bill. Beginning in spring of 2019, there was a change made in the way the advanced class 1 skim milk price was calculated. And Kentucky is a high class 1 utilization area, so most of our milk gets priced at class 1. Historically, that price was based on the higher of the advanced class 3 or advanced class 4 pricing factors. The change that was made and took effect early 2019 moved away from the higher of those two and takes the average of those two plus 74 cents. Bottom line is what that means is we are worse off when there's a huge diversion, meaning a big difference between class 3 and class 4 milk prices. And that's exactly what we've seen in 2020. We've seen class 3 selling way above class 4. Now, in addition to the way that formula has hurt us in Kentucky, we've also been hurt by the fact that with class 3 selling at a premium to class 1, a lot of those plants chose to depool that milk, which brought less money into the pool and actually increased our class 1 utilization during that time, which actually was at a lower price than class 3. So we were kind of hit twice that way. We've also seen a decrease in dairy cow slaughter second half of the year. As we start thinking about what 2021 might look like, this is kind of where I want to start. I want you to notice starting in the summer, for all these charts, red line is going to be 2020, blue line is going to be 2019. I want you to notice that going back to early summer, we've seen quite a decrease in dairy cow slaughter. So we're holding on to more cows. What this means is we're going to see higher production in 2021. Higher production combined with question marks on the demand side certainly brings a lot of questions about prices for next year. The other thing that I think has not gotten a lot of attention that has been going on is what feed prices have done. We've seen increasing feed prices going back to summer this year, so probably going to be hit on both ends, dairy producers in 2021. My forecast for dairy prices in 2021 is that we'll see Kentucky prices somewhere in the $17 to $19 hundredweight range. I'll be pleasantly surprised if we spend much time at all above 20 bucks a hundredweight on a state average basis in 2021. We entered 2020 expecting continued growth in the poultry market. I reached out to my friend and colleague, Dr. Jordan Shockley, to get some thoughts on this one as well. We definitely saw some COVID-related production impacts in poultry, although not to the extent that we saw in either beef or pork, but wholesale values still got hammered. Again, Redline 2020, notice what we saw from early spring to mid-spring. A lot of this, I think, was demand shocks and a lot on the restaurant side kind of adjustments there. Notice, though, we didn't get back to 2019 levels until November, so basically last month. Now, those wholesale values don't impact turkey producers directly, but they do indirectly. And I think the main reason why we're going to see cash receipts off for poultry in 2020 has to do with increased time between placements. And that's what these integrators tend to do when they're strapped margin-wise, is they just simply slow things down and there's more time between placement of flocks with those grower operations. However, long run, I think this is a healthy sector, and I think we definitely see improvement in 2021 that looks a whole lot more like we would have saw in 2019. Maybe more so than any other market, the hog market came into 2020 with some optimism. And a lot of that centered around African swine fever and what it had done to hog numbers in China and the export potential that provided. We really began the year looking a whole lot like last year. And of course, you know the rest of the story. Hog slaughter was off about 35% year over year in May. Again, red line 2020, blue line 2019. Notice the first 3 months of the year, there was almost no difference in prices this year versus last year. What was unusual about 2020, and it was as we continued to back those hogs up and deal with the demand shocks that persisted as well, we basically made our bottom in the summer about the time we usually make our high, and that's very unusual. You can almost set your clock by late summer being your best hog market and then fourth quarter being your worst. We saw our worst hog market in the summer. We've actually seen quite a bit better prices, though, in fourth quarter 2020 than we did in 2019, which I think gives us some reason for optimism going forward. I do think we'll see demand improvement both domestically and internationally in 2021, although a lot of indications are that China is increasing the size of its hog market, or increasing the size of its hog inventory. That's still going to take some time, so I do see some potential for export there. My best guess for 2021, Eastern Corn Belt prices start the year in the 60s, but they find the mid-70s by summer. If that's the case, prices year over year are going to be up something like 15 bucks a hundredweight, with the bulk of that being in the summer of 2021 when prices were so low in the current year. And then finally, we'll discuss cattle. Again, we came into 2020, I was fairly optimistic about having a better year than 2019. We had fewer cows out there, and we had a much more positive outlook on trade. Markets began similarly in 2020 than they did in 2019. I'm showing you actually federal inspected cattle slaughter, red line being 2020. I'm pointing to the bottom here. This is the first week in May, and those slaughter levels are off about 35% from where they were the same period in 2019. Our heavy feeder prices fell by about 25 bucks a hundredweight from January through April. A good chunk of this was COVID related. Some of the early piece probably was not. But we gained back about 2/3 of that by the end of the summer. And then it was a fairly steady fall market. And that's a relative term, you know, in the spring, but a fairly steady market for heavy feeders from summer to where we are now. The story on the calf market in 2020 wasn't so much about how much it dropped. It was about what we didn't get to enjoy. And spring peak was the big thing that we didn't see. If you look at a normal year, calf prices move upward from winter into spring as we have those calves being placed on spring grazing operations. We saw no price increase at all this year. In fact, we saw prices drop from February to April. I'm convinced that we not had COVID these calves that were selling in the low to mid 140s would have been in the low to mid 160s. So I think it cost us at least 20 bucks a hundredweight on our calf market this spring. We actually managed to hold prices a little bit above 2019 levels this fall, but again, I think this was more about what it did to calf markets this spring than what it did this fall. One bright spot in the cattle markets for 2020 was cow and bull slaughter. With more of a shift towards at-home consumption, combined with the fact that our slaughter cow markets did not get backed up the same way that our steer and heifer slaughter markets did, prices held much better for cull cows and bulls. They were actually above 2019 levels for mostly all the year. So we think about 2021, I think we're very likely to see another decrease in cow numbers at the national level, in Kentucky as well, in my opinion. I also think we're going to see demand improvement internationally for sure. I'm also optimistic, though, that restaurant demand improves by the second half of 2021, so I'm encouraged what I think we might see. My guess is we see higher prices pretty much across the board this year. Those 550-pound steer calves that sold for about $1.40, $1.45 in the spring, I think they'll be in the 160s by spring of 2021. I think we'll see groups and higher quality calves in the 170s, probably pushing the 180s by, say, April or so. And I do think we'll see a stronger calf market this fall as well. I think those calves that were in the upper 130s this fall will probably trade in the low to mid 140s by fall of 2021. So I look for a 5 to 10 weight increase in price year over year by fall, when most of our spring-born calves are moving through auction yards. I'll end there. If you have any questions or comments, feel free to reach out to me by phone, by email, or follow me on Twitter at KY Catalicon. Thanks.